Donald Taylor?
Can everybody? Yes. Can everybody hear me?
Yes.
Yes. Thank you, everybody, for attending this workshop. Bonding. One of the things that we have been trying to do is to offer more and more services that we feel that will make our DBEs and the DBE program more valuable to the DBEs. And one of the things that we have been discussing in some of our meetings, and one in particular was with the Road Builders Association at our advisory board meeting, was how do we make the DBEs more attractive, if you will, to the prime contractors. And one of the topics came up was about bonding. The DBEs have the ability to bond work. Say again?
Can you speak more directly into the microphone, please?
I'm sorry, hold on. Can you hear me better now?
Yes.
Can you hear me better now? Yes. So one of the things that we were going to do was to offer more services and so forth to our DBEs to make them more attractive to the prime contractors. And so one of the things that what we are trying to do at the UAH Mentor-Protégé Program is to put together a portfolio of services that we can offer. With that being said, one of the programs that come about based on that discussion again with the Road Builders Association was bonding. And so the Evans Agency was one of the organizations that we decided to partner with to provide those type services. And they're breaking it out in two categories. One is where you have a prime contract, or DBE that does not have any bonding capability, and those that currently have bonding. I'll let them talk more about those two different programs. And they're partnering with the SBA, so that's for those that doesn't have any bonding capability, still have the ability to bond them. With that being said, I'm going to introduce you guys to the Evans Agency. Maurice?
Yes, sir. Well, good evening. I have, again, I'm Maurice Evans. I'm the president, managing principal of SouthGroup, the Evans Agency. We have also my colleague, Reginald Thompson. He's there in our Jackson office, as well as David Russell Jr., who is there in our Birmingham office. So we're grateful for the opportunity to share with you about bonding and insurance for new and emerging contractors. And so this is a part of the University of Alabama in Huntsville's Mentor-Protégé Program and ALDOT. So we thank you again for the opportunity. We'll jump on in, won't prolong the time. Just a little bit about SouthGroup. Let me share just a little. Our mission at SouthGroup is to manage risk and build personal relationships and partnerships in an environment of trust, integrity, teamwork, and stability. SouthGroup currently has over 200 employees statewide, and now in Birmingham, our annual premium volume is $160 million. We have a total annual commercial volume of $63 million. And our corporate office is based out of Ridgeland, Mississippi. We are a top 100 P&C agency in Insurance Journal. We also have best practices, and we were 2020 best agencies to work for. So just a little bit about us. We provide business services, business insurance, liability, workers' comp, risk management services, property coverage, and commercial auto. Our website, as you can see, is www.southgroup.net. So that's a little bit about who we are, and we're going to talk tonight first about risk. And what are risks? Risks are the potential of losses. They are the potential of losses, and those losses must be quantified because it's impossible for you to manage what you have not properly measured. So risk management is the process of managing the uncertainty of exposures or risks that affect an organization. And so all of our businesses, regardless of whether you're doing site work or whether you're doing rebar work or you're a GC doing vertical construction or you're a concrete company, all of us have these three basic types of risks that we face on a day-to-day basis. We have a business risk, we have a strategic risk, and we have a hazard risk. So those are all businesses face these three types of risk, and we'll dive a little bit further into them to really hone in on the risk that you have in your particular company. But with those three types of risk that each company has, there's only 5 ways to manage those risks. We can try to prevent all losses, but all of us know that it is impossible to prevent all losses. We try to mitigate those exposures by putting in proactive strategies that if there is a loss, we reduce the severity of that loss. We try to transfer those exposures or those risks contractually to a third party. We can do that through insurance, or we can do that through a contract relationship with a third party vendor. We naturally assume a certain level of risk, and most of us know that by the means of a deductible. So I like to pause, and I know Christine is kind of handling the board, and I don't know if you can see them answering questions, but I like to pause for a minute, Christine, and just ask those who are in attendance, how many of you guys, I know most of you guys have an automobile, but if you can wave your hand or you can chat in the box, how many of you guys, by a show of hands or a chat, have a $5,000 deductible on your vehicle? You can, all of you don't have to do it all at once. I know it's a few of you guys on here, so not everyone at once. How many of you have a $5,000 deductible on your vehicle? Okay, do I have any takers? Christine, do you see anyone with their hands up? No one responding?
So far, just me. So far, just me.
Just you?
Yeah, that's too high.
Okay, just you. Okay, all right. Okay, well, let me bring it a little bit closer to everyone. How many of you guys have a $1,000 deductible? Not all at once. Not all at once. All right, Christine, you're manning the box. You see any hands up?
No, I don't see any.
All right, any hands?
I don't see
hands,
any.
no takers on the $1,000 deductible.
Says Veronica does. Yep.
All right, so Veronica has. Okay, I see. Mr. Mills. All right, he's got $1,000. I see you, Mr. Mills. All right.
Oh, okay.
$1,000. Okay. All right, I see you. Okay. All right. Now I'm coming down a little bit more, guys. How many of you guys have a $500 deductible? Not all at once. Wave, throw a hand up. I'm seeing a few here. I'm seeing a few. Who we have here? Let's see. Let's see who has that 500. A couple more people chimed in on that one. All right, 500, going once, going twice, going 3 times.
Going
all right,
4 times.
Here it is, guys. Last one. Going 4 times. All right. 500 seems like that's a sweet spot for everyone. So you've assumed $500 worth of risk exposure. How many of you guys have a $250 deductible? $250. Going once. Anyone? No takers. 500 is the sweet spot. All right. We'll stay with the 500. So let me tell you guys, because we have one person with a $5,000 deductible. We had one person with a $1,000 deductible, and then we had 2 with $1,000, and then most of you guys had $500 deductibles. So let me just tell you what you just told the insurance carrier. You just told the insurance carrier that you're very risk adverse and you don't want to assume very much risk. And so we want you to basically handle all of our risk management. And so the financing of your risk is going to cost you more. Everyone received that? You get that? You can see, Christine, you had the $5,000 deductibles, so your premium is a lot less than it would be for $500 or $1,000. Donald had the $1,000 deductible. His premium, he's willing to assume a little bit more risk with that $1,000 deductible. And of course, again, the financing or insurance, the cost of it is reduced when you use these 4 risk management practices. You prevent, you mitigate, you transfer, you assume, and then lastly, you finance. Guys, what we do in business, as we look at these 3 types of risk, we must assess every area of risk and identify those areas in which we're capable of assuming more risk, transferring more risk, and the cost of financing that risk will be reduced. Any questions on that? Any questions? All right, we'll continue to move on. So let's look at your business risk. Your business risk impacts the day-to-day operation of your organization, its clients and customers. But here's one of the biggest exposures that every one of us have as an agency or business owners: our personnel. Our personnel drives our productivity and the quality of our products. So regardless of whether you're pouring concrete or you're tying rebar or you're grading, doing some grading a site, your personnel is going to determine the amount of productivity and the finished product. And guys, I've got to share this with you. I was with a client, a very large sign manufacturer, on yesterday, doing a mid-year review with him, and he was telling me how challenged he was with finding skilled labor. And all of us in the trades have experienced that from time to time. He actually has been on a growth trajectory over the last 5 years, to where he's been growing by 20 to 25% annually. Because of the lack of skilled labor, he is now not able to reach his growth strategy because of the lack of skilled labor. So we've got a big challenge there. Your personnel drives your productivity and drives the quality of your products. And this is a business risk that you must manage every single day. Next type of risk we have is a strategic risk. It impacts the financial future of your organization. And I like to start with brand management because, guys, most of us, we do not understand how important brand management is to our businesses. But there's a saying that if you're not managing your brand, then someone is managing that brand for you. So you've got to make sure that you're managing your brand, that whatever your company name is, people understand the level of quality and professionalism that you bring to the table. Intellectual capital protection is a strategic risk because, again, you have people in your organizations that know your business better than you know your business. And so there are times when you have to protect that intellectual capital because your competitors are going after your skilled employees. So sometimes it's important that we put some golden handcuffs on some of those employees, and I might get Reggie to chime in on some key man type of policies that we could write to put those golden handcuffs on some employees. Losing or being unable to obtain bonding. That is a strategic risk because, again, guys, one of the challenges that we've seen in our industry is the inability to obtain bonding, which really inhibits your growth. I was meeting with a contractor who is a great professional on yesterday, very educated, very knowledgeable about commercial construction, but has been told over the years not to try to get bonded because it's too burdensome, too cumbersome. And we met on yesterday, and it was an eye opener to him, where he's been stuck doing $500,000 in business down when he could easily jump to $1 million, $2 million with obtaining bonding. So we're working with him now to obtain some bonding. This is a really big one right here, guys, that we're seeing mostly with a lot of our larger contractors. We're now seeing more of business succession or perpetuation plans being required by our surety, simply because, again, and I need to throw this out, I think we've got a second generation business on the call today, but only 30% of first generation businesses make it to the second generation. And then when we get to second generation and being perpetuated to the third generation, that number drops to right at 13%. So guys, business succession and perpetuation is a serious strategic risk that impacts the financial future of your organization. In most states, if you are the license holder, if the contractor is the license holder that qualifies that particular business, you have a limited amount of time to find a new qualifier. So you've got to have a good perpetuation plan in place. That's your strategic risk. And then lastly, most of us are familiar with our hazard risk, which creates a physical loss in the company. It's our auto fleet, which is big exposure right now. We're seeing serious increases in the cost of commercial auto because of all of the claims from distracted driving on our cell phones or eating. So we're seeing a lot of increase of claims in the commercial auto fleet, and ultimately, guys, frequency leads to severity. So that's one of our processes of identifying those type of exposures that we have. This is a big one now. If you would have asked about 5 years ago about cyber liability, many of our companies would not have readily said that they carried cyber liability. But as you can see with what's going on with the hacking of the fuel line, we've had huge companies get hacked. We've had companies that we write, pretty large companies, matter of fact, have spent over $1 million with cyber liability, and they did not have first-party cyber coverage. And we could talk a little bit more about that if you'd like to. But again, cyber liability, regardless of whether you're a small up-and-coming business or you're a large company, it would behoove you to get some cyber liability coverage for your business. Product liability, we talked about your products, your finished products, property damage, slips and falls, workplace safety. We know that with work comp. So all of these are hazard risks, and these risks create financial or physical losses within your company. So these three types of risks, business risk, strategic risk, and hazard risk, guys, are essential for us to grow our businesses and maintain our businesses. So any questions about those type of risks? Any questions? All right. So we have a 4-step risk management process, guys, that I'll just throw this out at you very quickly. If you want any more information on it, we can gladly help you with that. But our 4-step process is very simple. Identification of the risk. If you look at that first picture there, that is a very challenging exposure right there that these two men have. They're up on an extension ladder. There's no safety harness. There's no bracing. We don't know if someone's down at the bottom holding the ladder. Again, this is very dangerous. So we've got to identify those exposures, those risks. But not only must we identify those risks, we must quantify the cost. So what do I mean by quantification of the cost? If that employee is injured, one of those employees falls or slips, falls, there's a direct cost, but then there's an indirect cost that you'll have because of that injury. Your direct cost, that injured employee is out. You've lost the productivity from him. He's probably going to be out some length of time. So there's some medical expenses that are incurred. There are also some indemnity that's incurred as well. And then carriers also have a tendency of putting on reserves onto your claims that will drive up your loss ratio. And we could talk a little bit more about that. But you've got to understand, first, I've got to identify these risks. I've got to quantify those costs, because there's direct costs, and then again, there's indirect costs, because now you have to replace that employee. Excuse me, you've got to replace him, and you have to train someone to replace him. So you lose all the way around with productivity because of, again, this one exposure. So we identify the identification of the risk, quantification of the cost, and then implementation of the solutions. If you look at that next picture to your right, the bottom right, we see these guys now in a lift. Look how they're properly holding it. They have their vest on. They have some safety harnesses. This is implementation of solutions. The picture to your left, guys, can be a costly exposure, but with this implementation, you minimize or reduce the severity of a loss if there is a loss. Remember, I told you, you prevent, you mitigate. This is risk mitigation at its best. This is risk mitigation at its best. They're off of the ladder. They're on a hoist that lets them up to the roof to put these panels on. They're working as a team. They have a safety apparatus on. So again, this is implementation of solutions, and it doesn't cost a lot to do it. But then we need continuation of the process, because guys, each year you want to monitor and measure. What areas have we improved in? What areas can we improve in? What losses did we have in that previous year that could have been prevented? What losses could we have mitigated? So again, identification of risk, quantification of cost, implementation of solutions, and continuation of the process. It does not stop with 1 year. It does not stop with just implementing a handful of solutions, but this has to happen from the corporate level all the way down to the job site. Any questions about this?
I have a question.
All right. Yes.
So who is the leader in identifying these risks and then guiding the business owner through the other 3 steps?
That is a great question, Christine. Great question. So what we do as an agency, and you can do this with, I'm sure most of you guys and most of you businesses already have some agent or risk manager or risk advisor that's helping you with your risk management process. But we do a rather lengthy risk assessment. And we look at every aspect of your business, strategic and hazard risk, and we help quantify what those exposures are. Let me give you a great example. I'm glad you asked that question, Christine. We did a risk assessment on one of our large sign manufacturers 3 years ago. Actually, it was 4 years ago. He was actually in a 15,000 square foot building. We went in, did an assessment. We met with each one of the employees, 32 employees that he had at the time, met with each one of those employees, and we asked them the top 3 concerns that they have about what they do. We asked them the top 3 best things about your job, and it was all anonymous. So we received them. The agents, the company owner did not receive them, but we put it all together, quantified those costs. The biggest driver of his growth at that time was safety. And again, he's been in business now 25 plus years, and safety was the biggest driver. One instance that happened, they had changed blades, diamond blades that cut metal. And as a result, they had changed blades, and they had noticed that the blade would jerk, almost cutting the employee, but it would damage the $400 or $500 blade. Easy quantification of cost. What we found out was, after we looked a little harder, the company had changed 1 letter in the serial number of those blades. 1 letter in the serial number of those blades. So they were simply able to change blades. That $400 or $500 blade now is lasting longer. The employee is not at risk of being injured because of that blade pulling and nearly cutting them. But we also had some other safety concerns about the facility itself. They had totally outgrown the facility. Within 6 months time frame, he acquired a 30,000 square foot building, leased the 15,000 square foot building, and thought he was going to have to lease out a part of that building. He now occupies all 30,000 square feet. Safety was the identification of the risk that we that we identified, safety was his biggest driver for growth in his business. We put a safety coordinator in place. We started having weekly safety meetings, which again lowered his work comp premium. So all around, again, a good risk advisor will help create your holistic risk management plan. Did that answer your question, Christine?
Yes, it did. Thank you.
Any additional questions about that section? Any additional questions? All right, identification, quantification, implementation, and continuation, because guys, this is an ongoing process of you growing your business and being able to safely do it and perpetuating that business to the next level. All right, here's a shameless plug, guys. I gotta throw it in since Christine asked that question. The value of a good risk advisor. A good risk advisor knows who you need to know, acts as a consultant in the selection process of other team members, be it bankers, lawyers, accountants. We do a lot with helping our clients to identify those team members that are going to assist them in growing their business. We guides the business owner in the planning and implementation of a strategic risk management plan, and helps the business owner establish and increase their bonding capacity. That's all a part of what we do as risk advisors. And so any help that we could be to any of you guys, we're more than happy to do that. All right. Let's talk a little bit about the Surety Bonding, Surety and Fidelity Association of America. The coverages and requirements for Surety and Fidelity Association of America. It was founded in 1908. It has grown to over 650 surety companies, including a number of foreign affiliates. The members are insurance and reinsurance companies that specialize in fidelity and surety bonding. Surety companies are those companies that underwrite bonds, i.e., they take the financial risk. Bonding in itself is a risk mitigation tool that is readily accepted throughout the construction industry for owners to be willing to pay those bond premiums to help mitigate their risk. So coverages and requirements, current and construction related services industry, approximately, guys, $900 billion industry, 4.3% of the US gross domestic product, 7.8 million people in 2019 in the construction industry. There's been a great demographic shift in the construction industry ownership towards minorities and women-owned businesses. And by the end of 2019, more than 50% of businesses entering the construction industry were minority or female-owned. So who are minority contractors? Between 80 and 120,000 contractors and construction-related businesses. Minority contractors represent about 12 to 15% of the firms in the construction industry. But listen to this and look at these graphs to your side. But minority contractors account for only 3 to 5% of construction industry revenue. That's a big problem, guys. Look at the number of contractors and construction-related businesses. Look at the amount of minority contractors that's being represented, but then look at the revenue that they're generating. Here's a problem we have in our industry. So here's some of the barriers that we've identified as barriers for emerging contractors' entry and growth in the construction industry. Contracting opportunities, that's a big one. Information and management expertise. As the projects get larger, it's going to require more expertise in your management, your back office support, trained and reliable workforce, capability and capacity, performance issues, and dispute resolution, bonding and financing. Now I'll stop, I'll plug right there for a minute, because there's a lot of misunderstanding about what surety bonding really is. And as a result, with the contractor that I was meeting with on yesterday, he literally had not tried to get bonded because of all of the negativity he had heard about obtaining or securing bonding capacity. So guys, I like to let everyone know that yes, it is challenging to obtain bonding at times. It's even more challenging to grow your bonding capacity if you're not utilizing the right tools. And so we'll spend a little bit more time on that in the next few minutes. Any questions about our last slide? Let me stop right there. Is there any questions from anyone about these barriers that we've talked about? All right, no questions. All right. So how workarounds? Let's look at the workarounds and solutions. How have contractors have addressed barriers to bonding? And this is one of the conversations that I have almost every time with new and emerging contractors, is the only bidding work where bonding is not required. And so those projects, generally $25,000 to $50,000 down, don't require bonding. And so these contractors remain small. So that 3 to 5% of revenue is because they're not bidding and winning these larger projects. Bidding under a prime contractor's bond. Now, we're seeing a lot more of contractors requiring subcontractors to bid back to them. So this is kind of getting away from that now. Advocating for bond waivers. We see contractors doing that, and that prevents them, guys, from growing their bonding capacity. We want you to get in there and grow your bonding capacity, win larger projects to help grow your business. Advocating for alternative insurance and guarantee products. They're out there that the contractor can put out there for these for subcontractors to prevent them from having to put up bonds. Obtaining first bond or increasing bonding capacity. So again, our tracks that we work with first-time companies that have never been bonded, and we put them in. We put a plan together. What projects? What is your ideal size project? What's the single largest project that you've completed to date? And generally, we generally, as a rule of thumb, would go double the single largest project that they've completed for their first bond at best. So if I've got a contractor that has done $140,000, and I like to use this example. We did have a particular contractor that had negotiated $1 million contract, but had only done $200,000 in the previous year. Did not necessarily have all of the working capital that they needed with this to cash flow $1 million project. But the contracting officer was familiar with this contractor and knew their capabilities, knew what the quality of work that they could do, and was willing to work with them. So I had to negotiate then with the underwriter to see, we did a credit-only program to up to $450,000 for a single project. We were able to then go to the contracting officer, ask the contracting officer if he would give that particular contractor a task order for $280,000. So why did I say $280,000? The largest single project that they had done to that point was $140,000. The contracting officer agreed to do the $280,000 task order. They completed that work in 45 days. We issued another task order for $400,000. They completed that in 4 months. And then the last contract they completed all within 1 year, and it was $1 million contract. But we had to be creative with it because again, they did not have the previous bonding history to make that work. So that's where we have to be creative at times. All right, so why minority and women contractors are an emerging market for surety bonding? Demographic imperative, we've talked about more minority and women-owned businesses entering into the construction industry. The example that I just gave you was actually an 8A woman-owned business in Little Rock, Arkansas, that she had good history in the business, had suffered some illness a year or two prior, and was then trying to get back into the business. And we were able to get that bonding capacity because of that relationship with that contracting officer. Customer requirements. Many more customers are requiring minority business participation. And so and increasingly cost effective. They're smaller companies, don't have the overhead requirements of some of the larger companies. So it's increasingly more cost effective. Excellent pool of quality minority and women contractors. We have some great minority and women contractors that are doing exceptionally well in the industry, growing their bonding capacity, actually helping spin off other businesses that they're bringing on. Historically underserviced by the surety and financial industries. Minority businesses have been underserved. And so we've been intentional about seeking and going after those women-owned and minority businesses to provide them the level of service that they also need. And we connect them also with financial industries that are willing to work with small and minority businesses. Any questions?
David,
Hey, let's talk very briefly, guys, about, yes, okay. Christine?
Anecdotal evidence about getting bonding, reaching women and minority-owned businesses. I know from being, having had a woman-owned business that sometimes cash flow is, not that I needed bonding, but sometimes cash flow is an issue in small business. So what do you say when that's an objection to going forward? I mean, I know you're talking about all of this now, but just in a word, apart from just providing them evidence, storytelling, how do you help them grasp that aspect of it?
Well, first and foremost, what we do is understand exactly where that company is at in their financially where they, what is their financial strength. So one of the things we tell all of our contractors is there's something called the net quick. And that net quick is anything that you want to bid or bond, you need to have at least 10% of that for cash flow, to cash flow that project, because you're generally getting paid 60 to 90 days out on government projects. Okay, there are a lot of contracting offices are now changing that, and they're paying the small and minority contractors a lot quicker. We actually work with one developer that, as him having been a minority contractor, a small and minority contractor, again has implemented that he does net 10 on the payment. And my colleague Reginald Thompson is on. I'd like for you to share with one of the challenges with a business that we just had in Roswell, New Mexico, who had actually had a government contract and was needed the startup money to get it going, and then actually a 5-year contract. Reggie, would you mind just sharing a little bit of that?
Yeah, so that client's a little bit different. They are a management consulting company, and they were secured a contract, a federal contract that's worth upwards of $40 million over a 5-year period. So what we did, Maurice talked about your team members. You start talking about your lawyers and your accountants and financial institution relationships. That's a big thing that a lot of people don't talk to. So for the better part of a year, we set up several meetings with this particular client even before he officially became a client. He hadn't spent a dollar with us, so that we could talk with him and financial institutions about what his needs were, which were pretty substantial. He needed a line of credit for upwards of $2 million a month. And we had to work with him to find someone that would buy on board to what his project was. So one of the things that we talk about, as we're talking about financing and resources, the conversation about where a business owner wants to go with their company dictates a lot of what we do. So we start with the end in mind. We talk to clients about the fact that there's an exit for you at some point. What does it look like? Because either you're going to sell it to friends or family, you're going to sell it to employees, or you're going to sell it to a third party. But at some point, you're going to leave that business, whether you want to or not. So we start talking through those kind of conversations to see, based off of what you're really trying to accomplish at the end goal, let's look at these benchmarks that we can help you put in place, because it's really about building a better business. The business just happens to be in the contracting world, whether it's concrete or vertical construction, it doesn't matter. But to have a deeper conversation about where we're trying to go as a business and a business owner.
Does that answer your question there, Christine?
Yes, excellent. Thank you.
Thank you. Thank you. All right. So let's jump on to types of insurance. Property, building insurance, building personal property insurance. That's your contents. Casualty, and we could talk a little bit about key employee for casualty, and business continuation, business perpetuation, liability. Reg, if you would not mind, let's talk with some of our contractors about some of the things we're doing with key man policies, putting golden handcuffs on key employees. Let's talk a little bit about that, if you wouldn't mind.
Yeah, so, when you're looking at growing a business, there are a couple of employees that are absolutely crucial to the ability to grow, to the ability to get to that next level. And we've got to identify those guys early, because those skill sets are hard to replace. They're very hard to identify in the market. If you had to train someone, it might cost you hundreds of thousands of dollars. So we need to make sure that those particular employees have some motivation to be there. So when we start talking about, packages, we call them non-qualified packages that allow us to build customized programs for two groups of people, the key employees and actually the owners as well. And we can incentivize them by having tools in place that what they could leave on the table if they left you is punitive. But if you stick around for 5 years or 7 years, then there's a dollar amount at the end that you get that is very beneficial and motivates them to, number one, perform, because we can put performance clauses in them, as well as the payout whenever that time comes. So those are kind of some of the things that, you are the business owner. So no one's going to take the kind of risk that the business owner's taking. But that key employee is very invested in what happens to that business and the outcomes of that business. So we try to align the goals of the owner with the goals of the employee. And that's what we talk about when we talk about golden handcuffs and benefits for those employees.
So that's a little bit about our key employees, business continuation, business continuity. You've got to have that. Liability, commercial general liability, our workers' comp, commercial auto, and umbrella coverage. Now, I stuck this in here because a lot of our contractors do not realize some of the increased insurance costs that they are required to have on some of these projects. And so I wanted to take a minute to stick this here in here so you'll understand a lot of these contractors, and well, all of you that are primes, all of you that have subcontractors that may work for you, even if you're a subcontractor and you're subbing out a portion of your work, you're transferring that exposure. You need to ensure that each contractor, subcontractor, has the minimal limits that you have in general liability coverage. Why? Because again, if there is a loss, and there's a lawsuit, they're generally suing the insurance policy that you have. And if you don't have the minimal limits, or you don't require someone to have the minimal limits on your project, and you have higher limits, then they generally roll up to the next policy. But if you require that contractor, that subcontractor to have the minimal limits that you have, it may sometimes require them to get an umbrella policy for that particular project. But again, they're coming up to your level. And so that's a big one right there. Any questions about these types of insurances? Any questions? All right. All right, let's talk about bonding versus insurance, because this is a gray area with a lot of people. But surety bonds are a non-traditional insurance product. Surety bonds are similar to bank credit, and surety provides assurance that the business owner can complete the project and pay the bills. Surety companies guarantee 100% of the contract amount. That's why you've got to be on top of your game when we're talking about surety bonding itself, because it's not insurance. I had an electrical contractor in Kansas City, Missouri, had actually got into a dispute with the contractor on the project, and the contractor hit his bond. So did a bond claim and wanted him to go ahead and pay some particular suppliers before he had gotten paid by the contractor. So the supplier and all hit the bond. So the surety now is in an awkward position, because the contractor, the subcontractor that they bonded, really hasn't done anything wrong, but he didn't have the cash flow necessary to go ahead and pay that supplier until he got paid from the contractor. So the contractor now is upset, the surety is upset, but the surety now has to protect their interests. So they get involved. Now we'll talk a little bit, I don't want to get ahead of myself, but we'll talk a little bit about an indemnity agreement later. But this contract is a three-way contract. The contractor, the surety, is guaranteeing to the obligee, who is the owner, that the contractor, Mr. Smith or Mrs. Smith, can build this building for the contract amount that they've entered into. If they do not finish that project as contracted, then the surety steps in and guarantees that that contract is completed. 100% guarantee. Now, that requires some serious indemnity that we'll talk about a little bit further. Any other questions someone may have about this three-party type contract? Okay. So 3 types of bonds that we have here. Bid bond. The bid bond assures that the bid is submitted in good faith and that the contractor will enter into the contract at the price bid and provide the required performance and payment bond. So a lot of times, guys, this is where the heavy lifting is at, because this is where we've got to get you right, get your paperwork right, establish that bonding capacity. We have contractors that we've gotten $500,000 worth of bonding capacity, but they want to bid on $1 million projects, and it doesn't work like that. So this is the starting point with the bid bond. It assures that the bid is submitted in good faith and that the contractor will enter into a contract at the price bid and provide the required performance and payment bond. Now, I need to pause for a second here, because if there is a difference of more than 10 to 15%, depending on the surety, if there's a difference between you as the low bid and the number 2 bid of 10 to 15%, the surety is then going to want to know, why do you feel you can complete that project for that much less? So again, when they get into 15, 20%, they want to see cost breakdowns, the whole 9 yards. So again, those are the things that you got to make sure that you're tight on your numbers and that you're capable of entering into that contract. So next type of bond is your performance bond. The performance bond protects the owner from financial loss should the contractor fail to perform the contract in accordance with its terms and conditions. So let me give you a great example on this one. We have a contractor who had a total contract of 3.8 million on a military facility. They had a subcontractor that had 1.4 million worth of sprinkler system work. This particular contractor got 80% complete with the project and then walked away from the job. Did not feel he had the financial resources to complete the project, walked away from the project. The general contractor stepped in. The surety was put on notice. The surety did not move as fast as they needed to and put it on the contractor. The contractor then had to complete that work and then go after the surety to get the money back. So that's a performance bond issue. That general contractor had to step up out of their own resources, complete that project, bring in another subcontractor to complete that work, cost them right at $400,000. They had to complete that project. And they were awarded another contract by that contract officer before they even finished that project, because they knew that they would complete that project. The next bond is the payment bond. The payment bond assures that the contractor will pay specified subcontractors, laborers, and material suppliers associated with that project. So that's the payment bond. That's going to make sure that all of your suppliers are paid. Any questions about those three types of bonds? Any questions?
Nothing in the
Okay.
box.
So, yes, go ahead.
No, I said there's nothing in the chat box.
Okay, thank you. Okay, so how much will it cost? How much does bonds generally cost? So, one person, okay. Bonds generally cost between 1% and 3% of the total contract amount. So let me explain that to you. There is bonding that will start off, say the first million may be at 1.5% and the next million may be at 1.2%, but it's a blended rate between 1% and 3%. On our small contractors that we are small and emerging contractors that we start on the credit only program, those bonds generally cost a flat 3%. Now, I need to mention this also because there are some sureties along with SBA that will require from time to time a funds administrator. And this is a risk mitigation tool on behalf of the surety to ensure that this funds administrator or funds control, the funds administrator is a third party that will receive the revenue, will make sure all the subs and suppliers are paid, and then the contractor gets the remaining amount of the money of that particular draw. So I like to tell my small and emerging contractors that always use 5%. And you may say, why? If it's 1 to 3%, because most don't read the insurance requirements on some of these projects, and you'll end up having to get an umbrella. Or if we've got to use SBA, SBA charges a fee. And so we want to make sure that we have that covered as well as if there is a funds administrator or funds control required, that's generally about 1.25%. So as you can see, you're getting close to that 5%. So I like to tell them, use 5% to be on the safe side. So the cost of the bond is an acceptable project cost that is passed on to the owner. I have one landscape contractor that really hates getting bonds. until I explained it to him how it was actually the larger projects. It eliminates a lot of the competition for it. So he had been getting $1 million bonds, and now he was bidding on a project with a city that required a $5 million bond. Well, I had bonded, we had done two $1 million bonds and actually had done them 2 years in a row. And so now he wanted a $5 million bond. And he was really upset that they had put such a high number on that for that bond amount. And I started to explain it to him. I said, well, how many other guys are bidding against you on these $1 million projects? He said, it's 2 or 3. I said, okay, how many are bidding on this $5 million? He said, maybe 1. I said, okay, so now it's 50-50. You got a 50-50 chance of winning this $5 million contract. He then said, oh, the light bulb went off. He said, so the more I can enlarge my bonding capacity, the more I can compete on larger projects that others aren't capable of competing on. Ding, 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 the lights went off. So we want to increase your bonding capacity as much as possible. So the bond premium is generally paid out of the first draw. All right. So what to expect during the bonding process? And then we'll wind down this. We have a few more slides and we'll wind down. Who you'll work with. First of all, as your risk advisor, your bond agent, we perform all of the initial pre-qualification of the contractor. Primary surety industry contact. We're working with the underwriters. We're based upon our initial pre-qualifications of the contractor, we'll determine which carrier is the best company for you based upon their appetite. So different carriers have different appetites, just like they do with insurance. With surety bonds, they have different appetite. So based upon our initial qualification, we'll determine who's the best partner, who's the best surety partner for you. Now, I will tell you this, we've had situations in which we've started our clients off with one surety, but their appetite is different once they get above $1 million. So we move them to another surety that doesn't require some of the increased financials that you'll get required, you'll see required on some of the larger bonds. So we communicate with the underwriter, we help negotiate the level of surety capacity, and we provide sound business advice. And one of the best examples of that is we have a contractor who we had been bonding for a few years, and they wanted to do a $10 million project. We worked with the surety. We literally had to help put a business perpetuation plan in place that we had a template that we had to help, make it their own because of their age and the size of the project. So we had to do it. We had to help them with a business perpetuation plan and continuity plan. So we provided that advice, and we actually advised them not to do that project. It was a $10 million project that would have tied them up for about 2 years. And we understood, because we were meeting with them on a quarterly basis, we understood the other projects that they were looking to bid on some of the military facilities and with some of the housing stuff that they were doing. And as a result of our advice, they passed on the $10 million project. The contractor that ended up getting it was one of their main competitors. And because their bonding capacity was tied up, they now were not able to bid on some of the smaller projects that they had initially been winning. And our contractor ended up probably doing right at 10 million within that year's time frame, opposed to 10 million over that 2 years time frame. So that's how we work together. Reg, you want to chime in on that?
Yes, I want to talk to that a little bit. People see insurance as a commodity. They see surety bonds as a commodity. What the surety bond is part of your strategy for growth. Don't look at it as this inanimate object. your capacity to bond is part of a growth strategy. What we do as a team is talk to you about that growth strategy. Again, the same thing I hit on earlier, because we know that strategically, if we're picking the right projects, the right contractors to work with, that's another thing we talk about, because we know the general contractors in the area. We know the ones that are good and are not so good for our contractors to work with. We know the projects that may be a little bit too complex for them at the time. We know the ones that may have something real sticky with them. So look at surety bonding as a strategy for your company growth while you're getting other business out there. And then if we turn this thing multiple times a year and you start turning $1 million bond 2 or 3 times a year, then if you're 20, 25, 30% profitable, that money is coming to the owner. It's coming to you guys to redeploy in your business.
Great point. Thanks, Reg, for that. So again, we provide sound business advice because, again, we're working with our clients. We understand what they have coming down the pipeline. We're looking at their work in progress. We're looking at their cash flow. So again, we play a vital role with the surety underwriter. Their primary goal is to prevent default, make decisions on surety capacity. And that's a great point there, because we work close enough with our underwriters that when we recommend increasing our clients' capacity, we've had very little feedback, because we've worked with them enough that the underwriter trusts us to make those decisions. Even as much as saying, hey, this is a little larger than what they've done before. Would you mind checking in more regularly on them? I know you're doing, you guys are doing once a quarter. How about checking in, every 2 weeks to make sure it's going as well as possible? So, and then the underwriter extends surety capacity to ensure success of the contract. Any questions on that? Any questions? Okay.
Got a little bit of a quiet group today.
Just a little bit. All right, so let's talk about the pre-qualification process, what to expect during the bonding process, sound financial statements, whether they're internal compilations, got to be committed and competent personnel. You've got to have a good sound business plan. And guys, again, that's what a good risk advisor helps you put together. It's being very strategic. And then personal and corporate indemnification. Here's a big hang up with a lot of our companies. Personal and corporate indemnification. Indemnification simply means to make you whole. The surety, when you indemnify the surety, personally and corporately, if you're married, your spouse has to indemnify them as well. That's a large bone of contention for a lot of our men in the business, and their wives have nothing to do with the business, but they have to sign an indemnification agreement. And so that's sometimes challenging there. But you've got to be willing to understand that if you do not complete that project, the surety is going to step in and do what they're supposed to do to make the owner whole, but then they're coming back after you to make them whole. So that's the indemnification process there. Any questions about that? Any questions? Okay. All right, let's talk about the 3 C's of bonding. The 3 C's. First of all, is capacity. The ability to perform work. I see it a dozen and one times. We have contractors that we have gotten them a $500,000 capacity, but they want to do $1 million projects, but they haven't completed a $150,000 project. So again, what's your ability to perform the work? You got to ascertain if the business can fulfill obligations. Analyze past projects and services. That's again, looking at your capacity. Were we profitable? Did our margins hold? What could we have done better in that project to have made us more profitable and to provide better services? Review your current workload. Are you taking on too much that you don't have the personnel to perform the work? And then perform system check on the work and on your cash flow. Again, cash flow is important. That's one of our 3 C's. Capital, which is your cash flow, your financial strength. We need to do an in-depth, detailed evaluation on the business's financial strength, the annual report, interim statements, investment strategies, cost control, continuity, and succession planning. Again, that's always going to be in there with these 3 C's. And then your character, your references, your reputation. First of the business, reputations with vendors, with previous owners, with banks, with your subcontractors, your personal financial statement, your credit reports. All of these go into making up your character. I like to tell all of our contractors this: there may be times when your capacity is challenged. There may be times when you have capital challenges, and that will determine what your character really is. Because again, guys, in a perfect world, everything goes perfect. But on a construction project, we all know there are times when things don't go perfect, and your character is going to be tested. Reg, you want to chime in on that?
Yeah, real quick, one of the things that the last one on the report is credit reports. We talked about our strategic team. We have a young lady that we actually have started to work with our contractors and some of our other clients that does credit repair. It's a big deal. We've got one contractor in Florida. It's a mechanical contractor. We started working on their credit about 15 months ago, and we're just getting them to the point where we feel that they're ready for bonding. And we're working on, unfortunately, had a hiccup with the wife. So now when we have couples, we're trying to work on it together, because the husband may be in the business or the wife is in the business and the other spouse is not, but the credit of both has an effect on what we do. So again, making sure that we have our character shows through our credit. So we're very diligent right now about helping our clients get into a better situation in their personal credit. And we say it like this: look, there's not a business owner in the world that hadn't had some ups and downs. So we understand things on the credit. But what we try to do is have a strategy to get to 800 plus. And if they don't have a strategy, we show them that, and it takes some time. But to have impeccable credit goes along with the other things that we're doing that shows your character.
Reg, if you wouldn't mind, would you mind telling them a little bit about the LexisNexis and those reports?
Okay, so when you look at credit, people typically focus on Equifax, Experian, and TransUnion. They're the big 3 that everyone knows about. But there are over 400 supplemental credit bureaus. What people don't know is that some of the bureaus are owned by some of the financial institutions and they partner. So they're sharing a bunch of information across a whole landscape that you never see. One of the reports that is pretty substantial is called LexisNexis, LexisNexis. And LexisNexis has everything in your life on it, from every address you've lived in to every telephone number you had, to whether or not you've lapsed your insurance, real estate that you've owned. The older you are, the bigger it is. My LexisNexis is over 100 pages, and it has that much information on me. So it's one of those things that people really don't understand is out there, but it affects your credit worthiness. So we talk about not just credit, but credit worthiness, and looking at the landscape of things that could affect our contractors, our business owners that we work with in a negative way, and trying to cure those things before they become a problem.
Thank you for that, Reg. All right, any other questions on that section right there? Any other question about the 3 C's?
No question, but I have a comment about the LexisNexis. I've heard of it just from working with clients, but I did not know it was that in depth. That's really good information.
Yes.
Almost warrants.
And it's a bureau. What we'll do is we'll send out an email, the Consumer Financial Protection Bureau, and they have a lot of these supplemental bureaus. We'll send it to you guys, but LexisNexis is a credit bureau. There's a lot of credit bureaus. So you can pull it. You get an opportunity to get one free every year so that you can see it and see the validity of it, because a lot of that stuff you have to dispute. Other one, when we're doing life insurance, MIB, It's something that they pull now because they're doing a lot of electronic underwriting. So if you don't disclose certain things on an application, guess what? They have the ability to find that information and they will disqualify you based off of false information. So we've got to be up on these things and be prepared for what's going to happen, because typically, if say you open up a bank account, people don't understand right now that the banks are pulling maybe a major bureau, maybe TransUnion, but they pull some other supplemental bureaus as well because they want even more detailed information on you, because they don't want to underwrite a bad risk, even from having a savings or a checking account. So it's pretty deep when you look at what's happening behind the scenes in the financial services industry and how they work with the credit bureaus and the number of credit bureaus that are out there.
And just another point of that, Christine, when we've seen contractors at certain levels, like we have one particular contractor, I think he's at about 5 million in capacity right now, but we started with him, he was at 150,000. And we had to clean up some small tax liens that he had, state tax liens. I'm talking, we pulled it, and I think he had like 57 little tax liens, and they were like $5, $11, $15. He was unaware that they even had it. And so again, we went through, we got all of that cleaned up. And then after he hit $1 million, we started doing $1 million bonds, single projects. They pulled another report that blew me away. They had found his, he had a student loan that he had thought was paid off, and it had not come up on any other credit reports. But now that we were doing this $1 million bond, it comes up, and he has to deal with it almost overnight. So again, it's amazing the reports that they're pulling. So it's not just Equifax, TransUnion.
And I'll say this, and we'll move on after this. Credit bureaus are really extensions of financial institutions. They are who the financial institutions are looking for to help them underwrite risk. So many of your major financial institutions, your Bank of Americas, your Chases, your Wells Fargo, they actually own a piece of a lot of these credit bureaus, and you just don't know it. And then again, there's other supplemental bureaus that they're creating all the time. So the credit bureaus are an extension and a partner of the financial institutions. So we have to understand how that works to position the people that we work with for success.
Hey guys, I have a question. This is Donald. You're not saying though that a client will have to have an 800 or above credit score to qualify for funding. Okay, I just want to make sure we're clear on that.
No, that's for the best rates. you know, the better that credit score, the better rates you're going to get. So we talked about 1 to 3%. Again, that credit plays a big role in not just the rate, but also in the capacity too. So again, it's an ongoing process. We're working with our clients again to ensure that they've got a holistic plan, a strategic plan to grow themselves and their business.
Gotcha.
All right. Any other questions? All right, we'll move on. We're getting to the end of this, guys. So some of the information that the surety requires: organizational chart of your company, resume of key employees, contractor's business plan. We talked about that. Financial statements, last 3 to 5 years, personal and corporate. Work in progress report, continuity and contingency plans, subcontractor and supplier references, bank lines of credit if you have one, and letters of recommendation. We like to tell all of our contractors, all of your projects, if you can, get a good letter of recommendation to help build that file. The quality of your financial statements. So the compilations are your in-house financials. That's your profit and loss and your balance statement. So that's your compilation. I will tell you this, that for projects up to $1 million, compilations are fine, okay? When you start getting above $1 million, you're gonna have to go to reviewed financials, which a CPA reviewed financials. Now, I'll say this, that SBA allows a one-time exception for bonds of $1 million plus with utilizing a compilation, okay? That's an in-house compilation. So, but they generally like to see CPA reviewed financials, and those reviewed financials will vary based upon your accounting relationship. And then the most extreme level of quality of financials is a full audited financial, which again, when you get in your larger companies and you have $5 million, $10 million, $20 million bonds, you're going to need audited financials. Any questions about the requirements, information required? What we like to do, again, once we make an initial assessment, if it's a client that is already have an established bonding capacity, we like to know where they're trying to grow to, current surety that they're with, what the current capacity is, rates are, and then and where they want to grow to. How do we help them get to where they need to be? For the smaller emerging contractors, we'll generally try to start them with the credit-only program. If the credit isn't where they need to be, then we have some secondary carriers. The rate may be a little higher, but we've been able to identify a few carriers that if we've got a good track record, but you got good past performance, but maybe you've had some credit hits. You know, people get divorced, they go through some credit challenge. People, just go through challenging times all together in business. So you may have had some credit hits. We've got some companies that now will look at your past performance and say, look, we're going to give them an opportunity. Okay, it may not be as large as you want at that time, but if you'll just continue to get at bats, then you'll get round to home plate. All right. So what happens after you're bonded? And we're winding this thing down, guys. Project monitoring. Are there large costs and earnings in excess of billings? We want to make sure that you're watching your costs. I shared with you about that particular subcontractor. There was he was a sprinkler system contractor. He was not watching his earnings and billings, and as a result, when he got 80% complete, he had exhausted all his money and he couldn't finish that project. This is where changing to percentage of completion accounting is so important, because it's the best form of accounting as far as with construction accounting. Percentage of completion accounting is by far the best, because you'll get those over and under billings. All right, is the profit margin holding? Communication and feedback, if there's changes in your surety capacity, if you need some business assistance, if you need some job assistance, and recommendations and referrals on other contractors. So all of these guys, after you've been bonded, it's a continuation. It's not just a one-time thing, but the communication really needs to increase when you get when you started doing bonded work. Okay, quick review, guys, and we're going to close it out.
Maurice, I'm sorry, I have a quick question.
Yes. Okay.
On going back to the communication, the business assistance and the job assistance, particularly the job assistance, because you mentioned, what does that mean? Because you mentioned earlier about the labor shortage.
Yeah, so one of the things I was sharing with you about, there are different programs, and because we work with different cities, counties, municipalities, states, the whole 9 yards, we're aware of programs, be it trade associations and stuff like that, community colleges that have technical arms to it. Yesterday, when I was with the manufacturer, the sign manufacturer, he said he was short 6 employees. Well, I just met with the county administrator that told us about that new program that they had for the summer, where they literally pay for these young people to work in different businesses. They pay their full salary and all of the expenses that they incur to give them exposure to these different businesses and maybe earn a full-time position. So we help in that way where we're aware of different programs with technical schools or counties that are doing something. We help with some job assistance, even some business, some back office support assistance. We have a client in Memphis, Tennessee that he remotes in to QuickBooks for some of our clients that need some QuickBooks assistance. So he can remote in and help train some of your staff, even with QuickBooks. So those are some of the type of services that we help with. Go ahead, Reg.
And Christine, I'll say this. Look, we understand that the success of these contractors in your program and the ones that we work with is not just about completing the project, although that's the foundation. Running the business, and that's why you guys do what you do, is so important. So we try to find all of the areas that our clients could have some hiccups, all the areas that could slow them down, and try to find resources for that. So there are programs like this in every part, because they want to get kids in the inner city to work, or they want to get other people back going. So our job is to help put the team around a contractor to be successful. Surety bonding is one of those tools, but it's only one of many.
Thank you for explaining.
Thanks for that. Christine, does that help, Christine?
It's extremely useful information, especially at the industry that we're working with. Yeah. Yes, thank you.
All right. Quick review, and we're going to close it out. We're right on time, Donald. What types of insurance do I need for my business? All of us are going to need probably some property, casualty, and some liability. What are the 3 C's of bonding? Your capital, your capacity, and your character. What are the 3 types of risks? Your business, strategic, and hazard risk that you guys are managing all of the time. I will tell you that your business and your strategic risk are just as important as your hazard risk. Most people think that the hazard risk is the most important. It's not necessarily, because again, we talked about what your business and strategic risk entails. And guys, if you don't have good personnel, you don't have good productivity, you don't have good completed products, that's a business risk. Your strategic risk, you can't obtain bonding. If you don't have business continuity or business perpetuation plan, you're not going to grow that business the way it needs to be grown. So, and what are the 5 ways to manage risk? We prevent, we mitigate, we transfer, we assume, and then lastly, we finance. And then what are the 3 types of bonds? Bid bond, performance bond, and payment bonds. We thank you for your time, and if there's any other questions, feel free to have at us. Reg, you feel free to get back on as well. Any other questions, Christine?
I thank you very much. This was a really great presentation with so much valuable information for DBEs across the state of Alabama and the DBEs in our Mentor-Protégé Program. I don't have any questions. I would invite the other attendees to chime in, and especially those from other DBE supportive services, because I'm sure there must be some information that you're hearing that's new information to you. So, and then I also think that Donald wants to talk, Donald Taylor wants to talk about the bonding program. So wait, I think there's a question, hang on. Will the slides, yes, the slides will be available to you afterwards. Yeah, I don't have any other questions.
You know, Christine, I will say this to everyone. I think this is a really good time to be a DBE, especially working with an ALDOT. When this stimulus money starts to get going, you got to be ready. But it's going to help grow a lot of companies. So our goal is to help as many companies as possible put the foundation in and be ready to go when these billions start rolling out. because I think it's going to change some things generationally for a lot of the right business owners. And hopefully some of those right business owners are on this presentation tonight.
Yeah, and if they're not on tonight, hopefully certainly they'll be listening. And it's just something that I observed in listening to the content here is that it seems like working with you guys or working in this, working with a surety agent sets you apart as a business owner. You provide so much valuable, so many valuable services that, and you're so focused on growth, and that's what we're focused on as well. So just, yeah, really, really good info.
And Christine, this is Donald. And that's one of the reasons why I was saying, that we should use them as a force multiplier, if you will, with the DBs that we have, because like you were saying, that there are money that's coming down the pike, and we want to make sure as many DBEs as possible in the DBE program is ready. And if you're going to be doing municipal work, county work, state work, federal work, one of the barriers to entry as a prime and as a material subcontractor is the ability to bond your work, because all those organizations require bonding, right? And so I think this would be of great value to the DBEs in our current program, our future program, and the one that's been in our program in the past. And for those other DBE supported services online right now, we want to make sure we get this message out to those DBEs throughout the state, because we've been working to put together the actual framework itself on how we can all work together to make sure that when this money hits, that we have a number of DBEs ready to take advantage of it. But it's not going to happen overnight, though. That's why we need to, see where everybody is now. Get a needs assessment on everybody now, and status everyone, so we know what we're working with when that time comes.
Absolutely.
Donna, I'll tell you this. One of the things we can guarantee anybody that works with us, we're going to be honest with you. We're going to be very honest with you. And then we're going to hold you accountable to what your potential is. And if you listen, I think there is an opportunity for some major growth, because we've seen it work. We've seen it work over and over again for those who are committed to the process.
Exactly. And so what I want to do after this call, I have a couple of DBEs already on my list, and I've already talked to them. And one of them is on the phone right now. I'm going to get them the extra information, and we're going to go ahead and start that process. And like one of our other colleagues would say, hey, all we need is a few successes, and then we build on that, right? And to go ahead and get the program already primed. The other thing is, I don't want you guys to undersell the part about companies with existing bonding capacity as well, and the value you guys can bring to them as well to help them increase their bonding capacity. Because I had some interaction with one of our other DBEs that their bonding agents does not do half of the stuff that you guys are talking about, the value that you guys bring, right? And so I just want our DBEs to have access to as much as they possibly have access to, so that we're prepared when the time happens. We're prepared.
And we're willing to work with anyone, Donald, of any size. Again, we do our best work with those who are serious about growing their business. And so if you have those that are already bonded, and again, we're happy to work with them as well.
Okay.
And Donald, let me say this. I think one of the things Donald is speaking to, one of the things that you guys have to understand as business owners in the construction industry, federal work and public sector work is very good. But one of the things that a lot of ADs have struggled with, and other federal contractors, is going to the private sector side and getting some opportunities while they're growing their capacity on the public sector side. And a lot of you all have the skill sets and the knowledge to do it on both sides of the fence. And one of the things that we try to do is look out for opportunities through our relationships around this part of the country and others, so that we can bring quality contracts to the table with our developer clients, with our general contractor clients, and opportunities that we think fit for a quality business owner.
Yes. Perfect. Okay.
Well, guys, thank you again for your time. I appreciate letting us be on today, and we look forward to working with you guys in the future.
And we definitely appreciate you guys' effort. Danielle, Donald Mills, any other supportive services, you guys have any comments, anything you guys want to say before we go?
This was fantastic information. This is Danielle Barnes from Alabama A&M University. This is great information and fantastic speakers. Look forward to seeing part 2 of this.
Excellent. And I'll get you guys the actual format of the program itself. Once we're done with it, I'll send it out to you guys. It's not going to be a dissertation because y'all know how I get sometimes. There's only be a couple of pages so you guys can look at it and we can start trying to enroll our DBEs and our prospective areas into the program so that we can go ahead and get this program moving forward.
Sounds great. We look forward to it.
Okay. Well, if that's no, Donald Mills, you have anything before we go? Donald, you on mute. Okay, I guess not. Let's see who else is on here. Okay, I think that's it. Monica, you have anything?
I don't, Donald. I just think it was a great presentation and something that we can definitely use with all of our DBEs.
Excellent, excellent. All right, guys, I really appreciate you guys' time. I appreciate everybody else's time. I want everybody to continue to be safe, and you guys have the rest of the rest of the week. I hope it's productive.